Open enrollment. You're scrolling through your benefits options at work, medical plan, dental, vision, and then you see it. HSA, health savings account. You skip right past it. Maybe you checked a box once and forgot about it. Maybe you've been using it like a debit card for prescriptions. Here's what nobody told you. That little checkbox is the single most tax advantaged account in the entire United States tax code. More powerful than a 401k, more flexible than a Roth IRA, and almost nobody uses it the right way. First things first, an HSA is not an FSA. A lot of people confuse these two. An FSA, a flexible spending account, is use it or lose it. Whatever you don't spend by year end, gone. An HSA is completely different. The money you put in stays yours forever. It rolls over every year. It follows you even if you change jobs. It's your money sitting in your account. No expiration date. Now, to qualify for an HSA, you need what's called a high deductible health plan. That just means your health insurance has a higher deductible, usually $1,600 or more for an individual. In exchange, your monthly premiums are lower. A lot of younger, healthier people already have these plans and don't even realize they qualify. In 2024, you can contribute up to $4,150 if you're single, up to $8,300 for a family. And if you're 55 or older, you can add another $1,000 on top. But here's where it gets interesting. Most people treat their HSA like a checking account. They put money in, they spend it on copays and band-aids. That's not wrong, but it's leaving the real power on the table. Every other account in the tax code gives you 1 or 2 tax breaks. An HSA gives you 3. That's why it's called the triple tax advantage. Tax break number 1, your contributions are tax-free. When you put money into your HSA, it comes out of your paycheck before taxes. So if you earn $50,000 a year and you contribute $4,150 to your HSA, the government only taxes you on $45,850. That lowers your tax bill immediately. If you're in the 22% tax bracket, that one move saves you about $913 a year just for putting money into the account. Tax break number 2, the growth is tax-free. Most people don't know this, but you can invest your HSA money. Stocks, index funds, bonds, just like a retirement account. And whatever your money earns inside that HSA, no capital gains tax, no taxes on the dividends, nothing. It just grows, quietly and completely untaxed. Tax break number 3, withdrawals are tax-free too. As long as you use the money for qualified medical expenses, you pay 0 tax when you take it out. 0 on the way in, 0 while it grows, 0 on the way out. No other account in America does all 3. A 401k, tax-free going in, but you pay taxes when you pull it out. A Roth IRA, you pay taxes going in, but it grows and comes out tax-free. The HSA skips every single tax checkpoint. That's the advantage nobody explains during your 30-minute benefits meeting. Now let's run the actual numbers, because this is where it gets real. Say you're 30 years old. You start maxing out your HSA at $4,150 per year. That's about $346 per month. Instead of spending it on every copay and prescription, you invest it. You pick a simple, low-cost index fund averaging about 7% growth per year. Year 1, you've got $4,150, not exciting yet. After 5 years, your account has grown to about $25,000. That's $20,750 you contributed plus over $4,000 in investment gains, all tax-free. After 10 years, you're sitting on about $60,000. You only put in $41,500 out of pocket. The rest, that's your money making money. And you haven't paid a single dollar in taxes on any of it. After 15 years, your HSA hits $110,000. You contributed $62,250. The market handed you almost $48,000 in gains, tax-free. After 20 years, your HSA balance crosses $170,000. Let me say that again, $170,000. You contributed $83,000 total over those 20 years. The other $87,000, pure investment growth. And here's the part that should stop you in your tracks. Every single dollar of that $170,000 comes out tax-free for medical expenses. Now compare that to someone who invested the same $4,150 per year in a regular taxable brokerage account. Same returns, same contributions, but they're paying capital gains taxes every time they sell. At a 15% capital gains rate, they'd lose roughly $13,000 to taxes on those gains. So their ending balance isn't $170,000. It's closer to $157,000. You just kept an extra $13,000 because you used the right account. That's not a hack. That's not a loophole. That's the tax code working exactly the way it was designed. You just weren't told about it. So if the HSA is this powerful, why does almost nobody invest theirs? Because the entire system is designed to make you spend it. Your HSA provider gives you a debit card. They send you emails reminding you to use your balance. They make it feel like a spending account, not an investment account. And that's on purpose. According to the Employee Benefit Research Institute, only about 9% of HSA holders invest any of their funds. 9%. The other 91% are spending every dollar as it comes in. The healthcare industry benefits from this. Pharmacies, urgent care clinics, insurance companies, they all want your HSA dollars flowing through their registers as fast as possible. That debit card isn't a convenience, it's a trap. It turns a long-term wealth building account into a short-term spending tool. And here's the other part nobody mentions. The average American couple will spend about $315,000 on healthcare costs in retirement. According to Fidelity's 2023 estimate, that number keeps going up every single year. So the medical bills are coming whether you prepare or not. The question is whether you'll have a tax-free account ready to cover them, or whether you'll be scrambling to pay out of pocket with money that's already been taxed. The system doesn't teach you to invest your HSA. The system teaches you to drain it. Now the biggest objection people have is this. I can't afford a high deductible plan. I need the lower deductible so I don't get crushed by a big medical bill. That's a fair concern. But let's actually look at the math. A typical low deductible plan might cost you $400 per month in premiums. A high deductible plan might cost $250 per month. That's $150 less per month. That's $1,800 per year in savings just from lower premiums. If you take that $1,800 and put it into your HSA, you're already almost halfway to the max contribution, and you still have money left over if a medical expense comes up. You're not going without coverage. You're choosing smarter coverage. So here's your 3-step plan. Step 1, during your next open enrollment, look at the high deductible plan option. Compare premiums side by side. Calculate the monthly savings. Step 2, open your HSA and set up automatic contributions from your paycheck. Start with whatever you can. Even $100 a month adds up to $1,200 a year. Step 3, and this is the crucial part, log into your HSA provider's website and move your balance into an investment option. Most HSA providers let you invest once your cash balance hits $1,000 or $2,000. Pick a low-cost index fund and let it sit. Stop using the debit card for every little expense. Pay for small medical costs out of pocket when you can. Let your HSA invest and compound. That's how you turn a benefits checkbox into a wealth-building engine. 2 people, both 30 years old, both earning $55,000 a year. Both have access to an HSA through their employer. Person A treats the HSA like a checking account. They contribute a little here and there, maybe $1,000 a year. They spend it immediately on every doctor visit and prescription. Every year the balance goes back to zero. After 20 years, Person A has nothing in their HSA. Zero. They spent every dollar as it came in. Every medical expense was covered, sure, but there's no growth, no compound interest, no tax-free nest egg. Person B takes a different approach. They max out their HSA at $4,150 per year. They pay for small medical expenses out of pocket and keep receipts. They invest the full HSA balance in a low-cost index fund. They don't touch it. After 20 years at 7% average growth, person B has over $170,000, completely tax-free for medical expenses. And here's a bonus most people miss. After age 65, your HSA works like a traditional retirement account. You can withdraw for any reason, not just medical. You'll pay income tax on non-medical withdrawals, but no penalty. So person B now has $170,000 that can cover retirement health care or supplement their retirement income. Person A has nothing. Same employer, same benefits package, same paycheck. The only difference? Person B understood what the account was really for. This is not your fault. Nobody sat you down during orientation and explained this. They handed you a form, gave you 15 minutes, and moved on. But now you know. You're not someone who skips past the HSA anymore. You're someone who understands the most powerful tax advantage account in the country. And that knowledge, that's the kind of thing that changes your entire financial future. If this helped you see something nobody else explained, subscribe. Because we do this every week. Nobody taught us this about money. So let's talk about it.